Hey, everybody, welcome back to the Mustard Seed Podcast. This week I have on James Seyffart. James, how's it going?
What's going on, Joe? Thanks for having me back.
Good to have you back. This is going to be a fun conversation. I kind of want to rewind the clock, to maybe 2 years ago or so when the Bitcoin ETFs originally launched. I'm curious, like from your perspective, working from Bloomberg, covering ETFs, did you expect them to be as successful as they have been and sucking in the amount of capital that they have, accumulated?
Yeah, it's funny. We were very bullish, these ETFs, like extremely so, to the point where like some of our TradFi colleagues were like, yo, relax. It's not going to do that well. Like this isn't going to see that much money. And we just saw a lot of pent up demand. I saw a lot of benefit that could go to IRAs and like tax deferred accounts and just making it simpler for people to get exposure, which I feel like a lot of hardcore Bitcoiners, they believed they would do well, but they were like, if people want exposure, they have it. And we were like on the opposite side of that. And honestly, we weren't bullish enough. I mean, we were really bullish. We were out there with like, if you listen to a lot of these issuers, what they thought was going to happen, even BlackRock has been blown away. Even the most bullish people inside of BlackRock that pushed this Bitcoin ETF out the door, like by sheer force, there was people in BlackRock that didn't want to do this. And even those people are like, okay, this went even better than we thought. So I think the only people that like thought it would go this well were like hardcore deep Bitcoin believers who probably didn't know a lot about the market. They were just like, everyone's going to buy it, which is kind of similar to what I know this isn't really an Ethereum podcast, but like same kind of thing happened with Ethereum ETFs. The .eth people were like, it's going to get the same amount of flows as the Bitcoin ETFs. And we were like, no, that's not going to happen. But yeah, I mean, this blew away our expectations, and we're 18 plus months into this now, and um, it's going extremely well, but about as well as anyone could hope. They are the best and biggest launch of all time.
Yeah. What do you like if you're speaking with, other people at Bloomberg or, more TradFi people at BlackRock that, didn't expect it to be as successful as it has been? Like, what do you know what they're thinking of right now? Like, are they kind of in shock? Are they amazed? Are they curious and trying to learn more about Bitcoin now? Like, what do you think that they are thinking?
Yeah, so obviously I am a TradFi guy in most senses, right? Like that's what I
For
do. I'm
sure.
also a believer in Bitcoin, and I like what Bitcoin and crypto and some of the DeFi rails that are going to bring to the system. But there's still so many people that are just entrenched in the way they viewed this space in like 2017, and like they just can't wrap their heads around it. So, but it's gotten to the point where like they think it's all Beanie Babies and all of it's dumb, and but they've like, but Bitcoin's different. It's kind of like that they've kind of accepted that Bitcoin's a little different. They don't get it, but they think all this other stuff is still stupid, which to an extent is might be true. I do think there's a lot of value in some of these other chains, but like for the most part, there's people that like they just dig their heels in. Like I don't get it. I don't think it has value. There are other people who are a little more open to it, who have like done the research. I mean, you talk to anyone like we're in the process of writing a book, and we've interviewed a lot of people, and like without fail, almost every person you talk to in the space, when they first looked at Bitcoin, they were like, oh, this is stupid. And they come back to it at some point in the future and really start looking into it. And they're like, oh, actually, this kind of makes sense. And they start dipping their toes in the water. And I still feel like that's happening. But a lot of TradFi, both within Bloomberg or around Wall Street in general, there's a lot of people that just don't see any reason to hold this. And I should add, there's plenty of people that we talk to in, the world of TradFi and Wall Street, like they view gold the same way. It's just a pet rock. Like they don't care about gold. And for those people, I get it. If like you're somebody that doesn't think gold belongs in a portfolio, you don't see like the benefits to hedging against currency debasement, what have you. You want cash flowing assets. I can get why you wouldn't want to hold Bitcoin. But the people who are like kind of gold bugs or believe gold is part of a diversified portfolio and then also think Bitcoin is a complete sham and stupid, that's where I'm like, come on, guys, just take a little bit and like see what you can open your eyes a little bit and see what other people might be seeing. Maybe you think it doesn't have the same value or should be not what have you, but like I don't know. There's a lot of priors that people have to get over, and I just don't think that's going to happen. It's going to take a very long time for that to happen.
Yeah, you may be right. I'm curious if you have insight on this. Do you know who is buying and allocating to the Bitcoin ETFs? Like, is it, pension funds? Is it, financial advisors allocating on behalf of their clients? Is it, endowments? I think we've seen a couple of those. Like, who's the primary buyer? Is it just retail buying in the brokerage account? Like, who's the primary buyer of these Bitcoin ETFs?
Yeah, I mean, can I share my screen? on here? Yeah, let's do that. I'll share my screen because I actually have I look at this stuff, right? So the first thing I want to say for those listening, this is from the 13F, which is like if you're an institution of a certain size, you own a certain amount of equities, you have to report what you are long on. So this includes stocks, but fortunately, ETFs fall under there. So you have to report the ETFs that you hold. So what you're seeing here is that investment advisor category is the largest holder. Part of the problem is that is kind of a catch-all for a lot of different things. There are some what I would consider to be hedge funds that kind of fall under the investment advisor category. There are some like fund companies that technically fall under the investment advisor category. So it's a bit of a catch-all, but that also is a lot of true registered investment advisors, the people that you would go to pay somebody to manage your money. So it's a lot, and honestly, advisors by our estimates and by other people's estimates that are smarter than us at Bloomberg is like the ETF industry is probably 70% owned by advisors long term. So people managing other people's money. So yeah, that's largely where this is. But again, this is from the end of June. So this is as of June 30th. We don't get this data for a 45-day delay. So we didn't get this data till mid-August. And this was only about 25% of the shares of the underlying ETFs, right? So not everyone files. So a lot of it's going to be retail or foreign institutions that don't have to file 13Fs, but most of it we think is retail. So retail is the largest holder of these ETFs still as of June 30th. The second biggest holder on here is hedge funds. Largely, I think hedge funds are using this as the basis trade. There obviously are examples of buyers that are, long Bitcoin as a long-term store value play or a long-term play rather than a short-term basis trade. And a basis trade is just like they're selling the futures contract and buying the ETFs, and there's usually some sort of spread. Usually the futures contract selling for a little bit more than the spot market is at the time, and they're earning that theoretically risk-free yield from doing that. It's a delta neutral position, so you're not technically long Bitcoin because you're long on one end and short on the other, but there might be impacts on price. But as you can see, I have the change column there, and that is the smallest change area in June, largely because I think, as I was just saying, hedge funds are using this a lot for basis trade. The yield on the Bitcoin basis trade isn't that strong. I mean, it was 15, 20% at times in like November and December and into January last year. Last I checked, I did this like a couple of days ago, where it's like a 5% yield roughly if you're doing that basis trade on a 30-day weighted basis. So there's just not a ton of interest there. And then you get to brokerage, holding companies, bank, government, private equity, endowment, trust, endowment, pension funds all the way at the bottom. You can see actually pension fund has a zero change from the first quarter. I mean, pension funds, endowments, that is the area that most people think of when they hear institutions, sovereign wealth fund, family office. Those are the things that people think of when they think of institutions. But I'd argue most of these other ones are institutions as well. And we're just not seeing a ton of buying from that side yet. And part of it might be if you're a sovereign wealth fund, which we do know one in UAE has bought IBIT, BlackRock's Bitcoin ETF. There are examples of some endowments and pension funds that have exposure, but it's not a big part of what's happening here. So yeah, that's basically what we're seeing here. But these are roughly the I don't know, types of firms, types of companies that are buying these things. But again, this is only 25, 26% of the assets as of June 30th. So we won't see what the assets are. Ironically, we're recording this on September 30th. This is going to be the cutoff date for the next time we get this data, which we won't get until the middle of November. So I'll be putting out a report looking at who this is in the middle of November, and it will be as of, September 30th.
Yeah, I feel like this is a great table just to kind of like get your bearings of who's actually buying the Bitcoin ETFs. Quite fascinating. But yeah, what's this one as well?
So this is just the names of the largest holders. So you can probably see Millennium, that's a hedge fund. Jane Street, they're market making, possibly doing this as a basis trade, but almost certainly just market making. Brevin Howard obviously is heavily involved in trading crypto. Some of that's probably long only, some of it is definitely trading. Goldman Sachs, Horizon Kinetics is a fund company. You go on. SIG Holdings is a market maker. I can keep going, but one of the top ones on here you can see is Emirate of Abu Dhabi, United Arab Emirates. That's a sovereign wealth fund. So they're a big holder, but I mean, for those watching, you can see a whole list of other names, but these are the largest known holders of the Bitcoin ETFs as of June 30th.
Mm-hmm. So these Bitcoin ETFs, they now hold, hundreds of billions of dollars, over $100 billion at this point of Bitcoin. Like, how big can this get? Because, to someone that might be like, wow, like that's a ton of capital that's, in one of these, a few of these ETF wrappers, like the financial system is only so large. Like, do you still think it's can grow significantly from here, or is it, kind of saturated?
Very good question. So they own, as of my last calc, like 1.31 million Bitcoin, which is, depending on what the price of Bitcoin is, somewhere around 145 billion ish as of the end of September. Um, and I think they can get a lot bigger. To be quite honest, I mean, like I said, we only know 25% of the holders of the ETFs as it is. Advisors are still largely not here yet. They are the biggest holders, but like they're not, they don't hold a ton of this. If you think about it, the advisor, wealth manager, brokerage side of things is tens of trillions of dollars in assets. A lot of these platforms have not given the full green light to buy these things. A lot of people think, oh, you get an ETF, everyone can buy it. And that's just not the way this works. It's usually run by like there's guardrails. They don't want people like advisors that are using somebody's wealth platform, whether it's UBS or Merrill Lynch or Raymond James or some other wealth platform that these advisors are using on the back end. They don't want them buying things that are not good for their clients, like a 3x leverage ETF. Like you can't just buy that for a client as a long-term buy and hold. It's a trading product. And usually that process takes years, like 3 years. You need a certain level of liquidity, like trading volume. You need a certain level of assets. The track record has to be at a certain level. They are moving much faster with the Bitcoin ETFs and the Ethereum ETFs because it's just like you're holding a spot asset. We have the history of the spot asset. They've gotten big enough. But still, there's plenty of platforms that just aren't allowing these things to trade, like the ones that advisors are using in the back end, not even to get into what Vanguard has done and is potentially undoing, which we can get into. But
Yeah.
like these platforms, they have like the way to think about it is three levels, right? And you've probably, if you're on FinTwit or crypto Twitter, you've probably seen these tables of like this company allows you to buy with some restrictions. This company doesn't allow, this platform doesn't allow anyone to buy on their platform. And this one is just anyone can do it. So like usually there's a level of like, I can recommend this to my clients. And that's like the most cleanest, anybody can do it. And very few platforms are there. Most of the platforms at this point are in the middle ground where it's like, if you meet some certain requirement, if the client comes to you specifically asking to buy a Bitcoin ETF in their portfolio for them, you can do it. If they have a certain level of assets or ability and willingness to take risk, like all these things, you might have to jump through a bunch of hoops, but you can buy it. And then there's still a bunch of the biggest platforms in the United States that like under no circumstances can you buy it. Client can come to you, they can be worth $20 million. You can't put 1% into a Bitcoin ETF. They have to go do it themselves. So we're still pretty early days. More and more companies are probably going to move to that middle ground, and we're still waiting. It's very rare for you to be on the full, like you can just buy whatever you want side of things. So I think we're early there. And obviously, we talked about the fact that institutions aren't here. The one thing I will say is that institutions, they do like to use ETFs because one thing that's like a lot of people don't realize is like when you're trading an ETF, like you can get in and out without anyone knowing what the hell you're doing, right? Like you don't, it's not like the blockchain where you can see like this wallet is dumping this much money in or like this much money is moving in here and there. ETFs for the most part, unless you file that 13F, for the most part, no one's going to know what you're doing. So institutions like it for that. But if they're doing a long-term buy and hold thing, they much prefer to have like a separately managed account that's like private, or so they might use like Coinbase custody or BitGo or Gemini custody to hold it directly for them. They're like, I don't want to play in the public pool of the ETF. They could probably argue a better like lower rate for storing it. So rather than paying 20-ish bips expense ratio to hold these things, you could argue like a much lower rate for institutional custody. So I think it might be these ETFs are going to get used for trading vehicles by those institutions. But I think some of those, sovereign wealth fund, pension funds, endowments, if they're going to put a lot of money to work, they might just do it in long term. They might just go direct.
Mm-hmm. So I think you mentioned that currently the Bitcoin ETFs hold maybe around $145 billion worth of Bitcoin. Do you think that this will hit $1 trillion one day within all of the Bitcoin ETFs? And, if so, like how far away are we?
That would be absolutely insane. So like the best comparison I could come up with is we think that the Bitcoin ETFs are actually going to be bigger than gold ETFs. But honestly, gold ETFs are running away from Bitcoin right now. There was a point where earlier this year, Bitcoin ETFs were within a few billion of AUM of catching gold ETFs, which have been around since 2004 here in the US. But if anybody listening has been paying attention to the gold price, and money is pouring into these ETFs as well, they now have like a 75 ish $1 billion lead, $70 billion. Bitcoin ETFs at 145. The gold ETFs are well over 200 billion now. So so are these things going to have $1 trillion in assets? I mean, I get if Bitcoin goes up, 5x from here, then yeah, it's gonna be $1 trillion grouping, and it would be one of the largest groupings in ETFs. Period. I don't know. We'll see, maybe, but that's a little too exponential for me for where I see things going from my personal point of view. But
Yeah.
yeah, so I don't think so. But we do think they're going
What
to be bigger than gold ETFs.
Okay. What do you make of like the fact that gold ETFs are, still like, bigger than Bitcoin ETFs, but not like, magnitudes bigger yet? Like people will argue that the gold market may be a $25 trillion market right now, especially after the run up this year. And then the Bitcoin market's, a 2 point something $1 trillion market. Like, what do you make of, the fact that, gold ETFs are such a small component of the potential estimated total market size of gold?
Yeah, I think part of those estimates you also have to take into fact that you have to like look at this from like a financialized gold point of view. Like there's plenty of gold that's like just held as jewelry and in vaults and stuff. Granted, I'm not saying they're not comparable, but like it's a smaller number than like the 25-ish trillion that we were talking about there. But also, I mean, gold has been around forever. People trust it. Most people have it as a diversified portion of their portfolio. A lot of people make the same. There's a reason people call Bitcoin digital gold. So yeah, I mean, I completely get it, but also like gold is running right now for a whole host of reasons, whether it's central banks buying, people worried about currency debasement, people worried about inflation, you name it. But yeah, there was another part to your question that I didn't even get to. What was it again?
I feel like you covered most of it, mainly just
Okay.
like how gold ETFs are just such a small component relative to the the amount of gold that might exist out there.
Yeah, so I think, oh yeah, yeah. So this is what I remember what I was going to say. So the other part of it, one of the reasons why we think the Bitcoin ETFs can be a bigger portion of your portfolio is like for gold, it's just a portfolio diversifier and a potential hedge against currency debasement. That's true for Bitcoin as well in many Bitcoiners' eyes, right? That is a pure case for why you should have Bitcoin in your portfolio or an asset allocation. The other benefit to Bitcoin is it's volatile as hell, right? And it can be traded heavily. Gold isn't typically that volatile. Like right now, it's going on run. It's moving. It's moving like it's as volatile as Bitcoin, but typically it doesn't. So Bitcoin has the benefit of also being used as a trading vehicle for short-term things. And that volatility is, you've heard many other people say this, but it's a benefit, right? There's some benefit to that volatility for its investment purposes, which gold doesn't necessarily have. So I think that's another reason why we think Bitcoin as ETFs are going to be bigger than gold as a portion of the gold. And the other part of it is like gold's been around for however many thousands of years, right? Like these ETFs launch whatever it is, 12, 14, 15 years after Bitcoin was launched. So it's a little bit earlier and it's financialized very early on. So yeah, this is, as I view it, this is largely just financialization of Bitcoin.
Mhm. I'm curious to hear your thoughts on this one. Like, what's a conventional view of Michael Saylor at this point within Bloomberg or the TradFi community broadly? Like when he goes on, does a presentation or goes on a CNBC or Bloomberg and says, Bitcoin's going to become $100+ trillion asset class. Do people just think he's insane? Like, what is the conventional view?
I don't want to like talk for other people, but definitely people think he's a little insane. And Sailor is a little insane, but he's also like a really cool guy, really nice guy. And he's also like my biggest thing personally is like my biggest pet peeve in this world is when you say shit and then you don't put your money where your mouth is. Right? Like if you're saying one thing and doing the opposite or not doing it in your own personal life, like that bothers me way more than anything. So there's a lot of people that were criticizing Kathy Wood for the things she was saying, but like you could see her fund holdings every single day. You can see what Michael Saylor is doing in the market. He's calling his shot and he's doing it. And most people that I talk to, like who don't like completely hate Bitcoin, which they are out there and completely think he's insane. Most people are like, if I could sell my shares for $1.50 when they're worth a dollar technically, and buy something underlying for that money, I would do it too. So they're most of the people I talk to are kind of fascinated by the financial engineering side of things here. People are worried about it, like from the Jim Chanos point of view, like is the premium too high? Those are most of the conversations that people talk about, and there's like this. There's a lot of people, particularly even people on my team, who are like, "This is so stupid." But for the most part, I think people are just fascinated by what Saylor is doing from a financial engineering point of view. But yeah, I mean, it runs the gamut. So I guess that's what I would say. But I mean, Saylor's on Bloomberg TV all the time. Like it's not like we're not talking to him. So
Yeah.
yeah.
What do you think will be, the catalyst that makes more tradfi people kind of believe in what Saylor's doing? Like, and from my view, it's like, okay, strategy or MicroStrategy adopted their Bitcoin treasury strategy like over 5 years ago at this point. It went through a pretty dark bear market over a period of a year, and it's been one of the best performing stocks, the last 5 years. Like, will eventually people capitulate and be like, okay, like maybe there's something here? Or is it just is he always going to be this crazy guy that makes decent returns or really good returns?
I mean, from my point of view, when you see people that are saying they're insane, Bitcoin has no value, say that when Bitcoin is, $3,000 and it goes up to 20 and then it comes back down to like 10 and they are dancing on people's graves. And it goes up to 60 and comes back down to 16 and they're dancing on people's graves. And they'll be dancing on people's graves when, Bitcoin falls below 110,000 again. And, I feel like they just like completely moved the goalposts, even though the trend has been going in one direction. So yeah, I don't know. I for the most part, I think people have come around to the point of view that like what Saylor's doing is very interesting, and they're fascinated by it. Most people who even wrote like Bitcoin obituaries that I talk to are like, at this point, like it's so the narrative is there. It changes narratives very frequently. Like it's not a peer-to-peer cash system anymore, despite many people would like it to be. It's digital gold. And there's just a ton of people that believe in it and like what the asset is. And they've kind of just accepted the fact that this might be like sort of a psychological asset. Those are most of the open-minded people. But for the most part, I find like if you just look at people, they're going to dunk on it and say it's a failure at like the absolute bottom. And that's when you should seriously consider, looking into the space, I guess. But I don't know. I the people that I look to as good critics of Bitcoin, which there's not a lot. Like for the most people, the people who hate it haven't done the research and can't really have a conversation about it. But that's not necessarily the case anymore. But yeah, I don't know. I think people are coming around to the point where they're just like, Bitcoin is this something else, and I'm not going to pretend to know what it is, but I don't get it, and I don't ever need to get it.
Hmm. Yeah, it's fascinating. You brought up gold's volatility in comparison to Bitcoin. Do you think the ETFs have played a role in suppressing Bitcoin's volatility to some extent? Like, over if you compare the last couple of years to the history of Bitcoin, it's pretty clear that Bitcoin's realized volatility is declining. Do you think the ETFs play a role in that? Do you think it's more of just a matter of the sheer size that Bitcoin has become? How do you think about that?
Yeah, so I actually made the prediction that Bitcoin's vol was going to dampen pretty heavily within a couple of years of the ETFs launching. But that's also a trend that as you hinted at, it's been happening for long before we had any ETFs, right? Bitcoin's vol is basically down and to the right if you scale it properly over time. And part of that is because of what you said, right? It's just getting bigger. It takes more money to move things in a certain direction. Obviously, it's not 100% true. Like at the fringes, if there's no supply, a little bit of demand can really move things. So that's when you see these really volatile, explosive moves up or down, which Bitcoin is known for. It has a lot of volatility, and it has a lot of volatility to the upside, particularly. But I also think the ETFs are contributing to that lower vol. I mean, the people that we were talking about, those institutions, aside from the hedge funds that are buying this for long term, the advisors, the way that they think about this is it's a slug of a portfolio, whether that's 1%, 3%, 5%. You've seen other people now calling for much higher percentage allocations to Bitcoin. And what they do is when that they'll have rebalances, right? So the way that most advisors run their portfolios is like, I'm going to rebalance every 6 months or quarterly or annually. And then also I might have like ranges where like if some portion of my portfolio gets to be too big, I have to rebalance and go down. So like maybe if Bitcoin doubles from 5% to 10% before my rebalance date, I'm going to rebalance out of it. or vice versa. If Bitcoin goes from 5% to 1% and I have a 5% goal, I'm going to double down and buy it at the bottom or as it's going down. And I think that is going to decrease volatility because they're going to step in as buyers and sellers, because that's the way most, educated people who know how to trade and invest in markets, that's the way that they view things. And then you throw in the fact that the options market on IBIT is massive now. Like IBIT's options market is, I don't know this for sure, but it's like as big or bigger than most of the Bitcoin derivatives markets, like in the traditional crypto side of things. So you have institutions, and that's good because that's going to bring in more money. People are going to use that, and they're going to sell covered calls. They're going to do things to protect their downside. But the more people you have trading options and trading things around this, like it kind of like you kind of think like, oh, that's like when people think of options, they think of like zero DTE options and like taking large gambles and bets. But like that dampens vol as well when you have people that are able to hedge their risks on the upside and downside in varying different ways. And I think that's also going to dampen vol. But the other part of it is like dampen vol. Yes, it might not be great for people who love the dopamine hit of Bitcoin going up 100% over what time period. But if you want these institutions to come in, that's what they want to see. They want to see uncorrelated asset to the S&P 500 or the NASDAQ 100. And they want to see like maybe a little bit lower vol. That said, I think the volatility side of Bitcoin and these Bitcoin ETFs is a positive, not a negative, for many people. So it's a bit of a catch-22. But if you want these institutions, these endowments, pensions to put some money into this space, there's got to be some more history that shows like, it's a diversifier for a portfolio. They don't want something that's basically giving them levered tech stock exposure, which there are times where Bitcoin is heavily correlated to that.
Hmm. What's your response to a hardcore Bitcoiner that hates the Bitcoin ETFs and thinks, hey, like these ETFs are creating quote unquote paper Bitcoin? Like, what would be your short, simple, clear reply?
Yeah, I mean, they're not creating paper Bitcoin as far as I'm concerned. Like like BlackRock is not going to mess around and create paper Bitcoin exposure, like selling shares and not getting the underlying Bitcoin. Like it is not worth their reputation to be doing that. Also, they much prefer the number go up because like they earn a percentage on the fees of the underlying value of the assets. So like if they're like trying to hold back the price, they're hindering the amount of money that they can collect essentially because they're selling the Bitcoin and collecting the dollars. Granted, it's a little piece of the pie, but like that's what they're doing every single day. There's a little bit that goes to like running the fund. So yeah, I don't know. I don't, they're not creating paper Bitcoin. Bitcoin ETFs. There are times where they're a huge player in the market of driving what's going on in price, but there are other times where they're a smaller player. And for the most part, when you're creating these ETFs, particularly now that in-kind create redeem is there and being used heavily, people are delivering or taking delivery of the Bitcoin directly when they're creating markets in these ETFs. It kind of reminds me of like a lot of the tethered truthers out there.
Mm-hmm.
Some of that made a lot of sense. I was genuinely concerned about it, but like as more and more time went by, they're like, look, they're pumping the money. And it's like they're creating more shares as demand comes in. Like they're creating more tether because more people are trying to buy this asset. And they're like, no, they're just creating out of thin air. I'm like, as more money comes in the system, they need to create more shares or tethers in that point. So like people just misunderstand the way that the system works in many regards. When I talk to people who strongly believe that, I explain to them how creation redemption works in ETF. And I'm like, at what point here are they creating, paper Bitcoin? So and the other part of it is like some people are just never going to hold spot Bitcoin in their own keys and coins. And like it's easy, just memorize the password. It's like people don't want to memorize the password to their email, let alone something that's going to hold like tens, hundreds, millions of dollars. And this is just a convenient way for people to do it. This is the same, they can buy these products in the same way they could buy stocks or bonds or other funds. And it's just easy way to get exposure. And that's what these ETF issuers are providing. They're providing a wrapper to get exposure. And for better or for worse, if any of those people have like grandparents or parents or what have you, like, do you really think they're going to have a ledger set up to like take care of these Bitcoin? Maybe make the UI and UX way better and easier to use and safer, and so they don't have to worry about their coins and passwords getting stolen. And they don't have to worry about that with the ETFs. Throw in the fact that, these wrench attacks that we keep seeing happening. Like, what are you going to do if you wrench attack me and like I have all my money in a Bitcoin ETF? Like, there are some benefits here. I'm not saying there's no reason to like you shouldn't hold your own keys, like not your keys, not your coins, but there are plenty of people out there that just aren't going to go that route. particularly if you look at institutions. Like there, you can't just run like a pension fund or an endowment fund and just be the CIO and being like, yeah, so we own $1 billion of Bitcoin, and I have the keyword phrase, the 10-word phrase memorized in my head, and I have a ledger in my office desk. Like, no, they outsource that risk to other people. Like they want it decentralized. That's the way the traditional financial system is set up. There's a reason why people are complaining of the way the crypto works, in the sense that, like, you have an exchange that's also the custodian. Like that does not happen in TradFi, because there's a lot of like redundancy to make sure that things aren't happening. And still, with all those redundancies, we have issues. So there's a lot of reasons to be concerned about the way things work in crypto and in TradFi. I just am a seller of the narrative that these ETF issuers are creating paper Bitcoin.
Mm. No, yeah. I mean, that makes a lot of sense to me. You brought up earlier the IBIT options market. Do you like know what the primary use case of that is? Like, is it people selling covered calls on their IBIT position? Is it people like hedging their downside? Is it people just speculating and trying to, buy Bitcoin calls and, hope Bitcoin goes up a lot? Or is it kind of unknown? It's hard to tell.
So I will say that there's like $43 billion of notional open interest in the Bitcoin options market, and like 97% of that is in IBIT. So IBIT is the vast majority of all that volume. I haven't looked at the put call ratio, so let me I can pull it up right now.
Okay.
But I would say, like, early on, it was heavily tilted. Like it was almost all calls, and they were all like deep in the money, like long-term calls, betting on, basically the equivalent of IBIT hitting a like $180,000 price point for the most part. Like
Hmm.
that was, like, things were heavily skewed that way. It was a lot of upside calls, like right when options came to market, which was like a lot earlier this year. So, yeah, it that's the way things were being used, but now it's a lot more even. So right now the put call ratio is 45%. So the ratio of
Wow.
put interest to the call interest is 0.45. So it's a little bit tilted towards the call side, but not much. It's pretty even at this point. So I don't have a breakdown of like where on the pricing mechanism these things lay. I probably could have looked it up, but for the most part, you know it's evenly distributed.
Yeah, interesting. It's cool. Good to know. Beyond the Bitcoin ETFs, we touched on it a little bit earlier, but I kind of want to get your broad thoughts on it. Like the Bitcoin treasury company phenomenon has been pretty interesting. What are your thoughts on what's happening there with strategy and then the long tail of many other companies?
So I do not cover this area, but obviously anyone who's in this area has some sort of point of view. Um, I'm fascinated by it, but I don't own any of these directly at this time. Um, my view is, like, of two thoughts, right? I can make two arguments. One, which you've probably heard from others in the space, is like these things are basically closed-end funds. Most closed-end funds tend to trade at a discount. That said, not all closed-end funds. I do write about closed-end funds. Not all of them trade at a discount. There are some times where if you have an active manager who's really good, you actually will end up paying a premium for the underlying assets that are locked up there and getting exposure to that talented manager or some sort of subset of it. Um, so I could see that argument. Like this is trapped capital that's doing one thing, and there's cost of running a company, there's cost of running these strategies, and therefore it should trade at a discount. The flip side of it is I kind of fall more into this camp where, like, I can fully get why I would trade at a premium, right? If you are able to accrue assets, whether it's using financial engineering or harvesting volatility in different ways to, like, increase your Bitcoin per share in the same way that a bank tends to use its balance sheet and leverage to earn like excess capital on their underlying assets. Like most banks tend to trade at a slight premium to their book value because of their ability to do that for whatever reason. So I would make the argument that I think it makes sense that these things should be trading at a slight premium to their MNAV. 5 times the underlying value, 10 times, probably not, is my like the way I think about it. Like that just seems insane to me. Uh, Bitcoin's what 114-ish today, or 110, we'll say. Like you're buying Bitcoin for 5. But the thing is, like, a lot of people were complaining about this many like years ago. Like if you had bought MicroStrategy, he was able to increase his Bitcoin per share by way more than enough to offset the costs that you overpaid for the underlying shares at that time. If you had like, you go back to like 2021 ish, 2022, and you bought the equivalent amount of Bitcoin and you bought the equivalent amount of MSTR, you have way more exposure, obviously, because you've increased your stack on the MSTR side of things to offset the premium you paid. So as far as they can keep earning that, additional Bitcoin per share, it makes sense. But I just worry how long that can continue without like actually monetizing the underlying assets. I know this is obviously mostly completely Bitcoin, but like I think it like from my point of view, the idea that you can put like something like Solana or Ethereum to work in staking and in DeFi protocols and things like that and earn income kind of makes a little more sense to me in this world. But obviously, like MicroStrategy has done it. People like to talk about them being over levered. He is levered, but like not to a crazy amount. All the stuff he's doing is very interesting, first of its kind. I don't know. The way I look at it is it's kind of risky. You're using leverage to bet on Bitcoin, and you know bad things can happen. But I don't know. There's a lot of Bitcoin purists that hate these things and think they're just ripping people off, and it's just like people know what they're getting into when they're buying these things. They know I hope they understand the risk. Like this isn't guaranteed to go to the moon. But yeah, it's just like actively managed leverage on top of Bitcoin, as far as I'm concerned, and I can make the pitch for that.
Yeah, it's funny because to me it seems to be probably one of the most hated trades of all time. Where it's like we were talking about earlier, tradfi guys traditionally will hate Bitcoin in general, or just don't get it, and then Bitcoin treasuries are like, okay, here's Bitcoin with intelligent leverage, and some of the hardcore Bitcoiners hate that, and then the tradfi people really hate that, and it's like this tiny little segment of like some investors that think, hey, like maybe this is a really good idea.
Yeah, I mean, I just listened to a podcast with Adam Back talking about this for like literally an hour, and the way he looks at it's like I don't know. If you're a Bitcoin maxi, you kind of like are anti equities and cash flows in a way. And like the idea of like combining, the equity markets with Bitcoin is like the antithesis to them. And they're like Puritans. But honestly, like it's a free capitalist market. Let people take shots at whatever they want to do. And honestly, I really do think a lot of these, maybe a lot strong, but I think a bunch of these are going to end up coughing up their coins, or there's going to be a lot of M&A, as we saw with Semler. So I think there's going to be a lot of that down the pike. But yeah, I mean, I like I said, I'm not somebody that's like heavily paying attention to the space. I'm tangentially paying attention. I get why people are trading them. I think they ate up a lot of the altcoin season that would have normally happened. A lot of people started trading these types of treasury companies, mostly Bitcoin, but also some of these other ones. So that's kind of interesting to me. But other than that, it is what it is. And honestly, like let people do what they want with their own money, as long as like. But the other problem is like you've seen like the SEC is now concerned because there's a lot of insider trading in some of these things and moves that are happening, and it's just like I don't know, people who are doing that are going to get caught. Like I think they're used to like being on crypto exchanges and not having to worry about this, but like you can't trade on non-public information that yeah, whatever. We don't need to go into that. But so I'm more worried about it from that point of view, that there's some sketchy things going on. But for the most part, I get it. Let people do what they want.
What do you make about strategy not being included in the S&P 500 as of the last decision day? Did you expect that it might happen? Do you expect that it could happen in the future? Are you surprised that I guess the treasury community made such a big deal about it, or was like very excited about it? How are you thinking about that?
Yeah, I mean, the treasury community was saying things like the S&P 500 needs MSTR. MSTR doesn't need the S&P 500. And I'm like, this is the largest, like it has tens of trillions of dollars of assets tracking the underlying index. Like it'll be fine if it adds MSTR too late. It's added plenty of names way too late. It added Tesla like well into its run. And it's still the benchmark of choice for pretty much anyone looking at US equities, honestly, global equities even. So I actually wrote a note saying that the three most likely candidates that I was confident in were AppLovin and Robinhood. And then I thought MicroStrategy, or strategy, I should say, MSTR, was a candidate, but like I was less than 50% that it was going to get added, just for a whole host of reasons, right? So I got two correct, AppLovin and Robinhood. And Yeah, kudos. But the reason I was skeptical on strategy is multiple reasons. One, ironically enough, everyone, I'm sure your listeners know what happens with like the accounting standards, and one of the reasons why they were eligible now all of a sudden to be in the S&P 500 is because one of the criteria is that you need to have the prior four quarters of earnings all sum up to being positive. So once my strategy adopted new accounting standards and took that massive price movement in Bitcoin, they were able to incur like a very positive quarter at the end of Q2. And then your most recent quarter has to be positive. They were eligible that way. The committee probably had, I mean, I know for a fact the committee has full discretion. So one, they were probably looking at that and like, is that really earnings? Like they might, if this keeps going on for another like 4 quarters, I think strategy is going to get in, right? If Bitcoin maintains its price level or goes higher, I think there's a decent chance that it could get in at a future rebalancing date. The next one is in December. The other part of it is that a lot of people didn't realize is like the index committee, again, they have full discretion, but they also like they're worried about sector balance. Tech is the most heavily weighted sector in the S&P 500 by a long shot, more than double the next closest. So I think tech is like 32 or 34%, and financials is like next at 14% of the weight. They also have like a ton of names. There's like 68-ish names in tech in the S&P 500. So it's not quite the highest, but it's up there, even the number of names. So like strategy is technically a tech stock. So I think that also kind of goes against it a little bit. So that's another thing. So there's all these things that could go in that the committee is going to take into account. And the final thing I would say is like there are plenty of names that are eligible for like many quarters, like years that don't get in eventually. AppLovin is a good example. It was eligible last December and didn't get in until this quarter. It's been eligible each time it rebalanced since December. It just takes time sometimes. So the other thing they're worried about is turnover. They don't want to be turning over like tons of names every single quarter. So they only usually do a handful of names each rebalance. There are, by my count, about 60 names in the S&P 500 that are eligible to be removed. They're too small or they don't meet some other criteria for whatever reason, and they could be kicked out of the index. Whereas we had, by my count, 26 different names that could have been added this rebalance. So if they really wanted to, they could put in 26 names and take out 26, but they want to keep the index is supposed to be there for the long term. So once they add a name, they don't want to be taking out in 2 quarters. So they're slower to add things in and take them out. So it's more slow, like almost like a moving average in the way that the index committee looks at the market. So yeah, I think they will most likely be eligible in the coming quarters, coming rebalances, if you believe Bitcoin price is going to continue to go up. So we'll see what happens. But yeah, I wasn't surprised at all that they weren't included. There's good reason for it. I think the index committee didn't have to jump on it the first quarter they were eligible. And like I said, there are probably concerns about like the stability and ability of the earnings to continue moving forward. But don't count it out. It's not done yet. Like like I said, it could take years, and they could be added at some point in the future.
Yeah, that's the volatility of their earnings given the current gap accounting standards and the fact that, as we all know, Bitcoin is an extremely volatile asset, even if its volatility has been decreasing. I kind of wondered that kind of what you brought up was like, okay, to be eligible for the S&P 500, you needed to be, the last quarter had to be profitable, and then the cumulative last 4 quarters need to be profitable. I had wondered in the past, like if they do get added, well, then whenever Bitcoin has a bad quarter or bad year, will it eventually get removed and then added back again? Like would it? But like you said, you made a good point that they don't try to churn it too much. But I do wonder if that could happen where the S&P 500 over time, if it was aggressively adding and removing something like strategy, then they would kind of be maybe buying the tops and then selling the bottoms and buying the top. But I guess they probably wouldn't churn it as much as I originally thought potentially.
Yeah, there are examples of companies that have gone in and out of the S&P 500 over time, but like it's not because like they're not going to do it because they have bad earnings. There are plenty of stocks in the S&P 500 that have like negative years, not just negative quarters. So it's more about the size. So right now you have to be at least 22.7 billion, I think is the number to be included, subject to change going forward for other rebalances. But that's why I said there's like 60 plus names in the S&P 500 whose market cap is below that level. So yeah, I mean, if strategy goes in and then all of a sudden falls to below a $20 billion market cap, one, if you're a holder, you have way bigger problems to deal with. and two, then theoretically they could be eligible to get booted from the S&P 500. But yeah, I don't know. The churn is kept to a minimum, is what I would say.
Yeah. I listened to a podcast, I think with your boss or guy on your
Yeah.
team, Eric Bahanas, and they interviewed some guy that was part of the S&P 500 committee. That was like a fascinating podcast to me, I guess, because people always say that the S&P 500 is passive investing or their ETFs that track that index. Yet you could argue that it's an actively managed index.
I mean, there really is no such thing as truly passive investing when you get down to it. So the way I think about passive and active investing is the way I tend to also think about decentralization. Like it's on a spectrum. Like I know people are like they're absolutists in this framework, but there are levels of things where like you can use some blockchain tech for things that are slightly more centralized than you would want something for like a decentralized store of value, right? Um, and the same thing is true for passive, right? We have passive rules-based indices that are going to change their holdings every single quarter. I mean, is that really passive? Not really. They're just following like a quantitative rule set. And then you get the S&P 500, which is very close to the passive side of things, but there's an index committee that's actively deciding what goes in and out of these things. That said, if you look, the best example of this is if you look at the S&P 600, which is their small cap index, versus the Russell 2000, which is Russell's small cap index. Russell just adds anything. Like if it launches, it meets the criteria, it's in the index, what have you. The S&P 600 small cap beats the Russell 2000 very, very, very consistently over time because they don't have junk stock. They don't have stocks that are like,
Mm.
biotech stocks that are betting on FDA approvals. They don't have all these things that have like no earnings and are long shots. Granted, some of them work out, but for the most part, a lot of them don't. And the S&P 600 also has like some sort of positive earnings criteria. And over long term, it's better for investors, theoretically. That said, the S&P 500, it kept Tesla out of the S&P 500 for many, many years after it was added to, the Russell 1000, like 6, 7 years, something like that. So there are pros and cons. There are examples on both sides where I can probably point to names and you can point them out and be like, this was never added and it went to zero, despite it going up enough at certain different points and things like that. So yeah, it's a spectrum. That like the way to think about it, it's not black and white. There's some level. There's a lot of gray in the middle. The most passive thing you can do is probably VT, the Vanguard, or there's a ITOT, I think, from iShares. They're just this total stock market. So they
Mm.
are literally investing in the global equity markets, like down, they have like tens of over 10,000 stocks in there, right? So that's just like, here's the whole enchilada put on a plate for you, and this is what you have. And everything other than that is some level of, non-passive exposure.
Mm. Yeah, it's fascinating to think about. I think there's a guy. His name's like maybe Mike Green or someone. Like he's done research and he's argued that like passive investing kind of like misallocates capital. What do you think about his perspective?
So Mike was on my panel. He hosted an event at New York Stock Exchange. He works at a company called Simplify ETFs. First of all, that
Mm.
the event they threw at the New York Stock Exchange last week was one of the best content events I've been to in a very long time. So shout out to them. I don't know if they'll ever see this. Two, me and Mike debate a lot.
Hmm.
There's a lot of going back and forth. He always is on me about the data that we're using and what we're showing. So yeah, he believes strongly that passive is misallocating capital. I think to some small extent he's correct. Like there definitely is some sort of misallocation going there. If you're in the S&P 500, you're in some of these big passive indices, you basically have a tailwind at your back because money is pouring in via the 401k market, people dollar cost averaging into the market over time. There are benefits. It's probably decreasing your weighted average cost of capital. There are benefits to doing all of those things. But at the end of the day, like active managers are what decides what's happening here. Like we don't get GE getting booted from the Dow and other things because like passive money is coming in. There's plenty of examples of like stocks near the top. Like look at Google. Price to earnings ratio is extremely low compared to all the other Mag 7s and even plenty of other stocks in, the S&P 500 because people are worried about AI's impact on their search business. And like that's despite the fact that they're one of the largest holdings in these passive indices and money is pouring in, still there's like massive divergence in the way that these different stocks are trading. So I think to some extent there's this whole thing where people like to say flows over pros, like where the money is going is more impactful than like valuations necessarily. At that event I was talking about, David Einhorn was on stage where he basically said like he doesn't believe valuation matters in market anymore. everything is set up just to predict price rather than valuation, which is fair. So I don't know what the solution is. I do think it's some part of it, but I think it's also overstated by the people complaining about passive. And my point is like, if you're an active manager, just take advantage of it. Either lean into it or bet against the issues that passive is causing and take advantage of those dislocations in the market. So yeah, I get it. Their flows are definitely somewhat distorting things, but at the end of the day, like when idiosyncratic things happen to individual names, whether it's a company or what have you, like the market is punishing them or rewarding them. Like Oracle went up, 20% the other day on an earnings release. Like that's not passive flows. Like for the most part, active managers, active decisions, things are still being valued and priced in the market. So yeah, and I think part of the other problem is like one of the reasons passive is so big is because one, it's simple and you're just betting on it. You're not turning over you're holding things that are winning for the long term. So it's like there's momentum baked into it. But the other part of it is like active managers who did well, there was like this in the 60s and 70s, like they were charging a lot of money, but they were like saying once they reach economies of scale, they'll return it to the investors. There's these fees called 12B1 fees that are supposed to be like marketing. They're supposed to go down once you get to a certain asset level. And these asset managers that were pulling in money, charging 1 to 2% to like just sit in basically something that's not all that different from these passive indices. Like if they had passed on those and made those products way cheaper, lowered the fee to 30 bips or 50 bips the way that a lot of active ETFs are, I don't think passive would be as big as it is today. But they never passed on the economies of scale. You had people earning hundreds of millions, billions of dollars in the markets, and they're just never lowering the fees for the exposure that they were giving people. So I think there's kind of this like pushback on the active area of investing, particularly in the tradfi markets, because they never passed on those economies of scale and benefits they got once they got so large. I mean, here's another stat. If you look at the actively managed equity mutual fund market here in the US, tens of trillions of dollars, they see $1 trillion in outflows every year and their asset levels go up
Mm.
because the underlying market has been going up 10+% a year. So all this, we call it the bull market subsidy. It's like the only business in the world where like you can see money leave every month, every quarter, and your revenue is going up because the underlying market is increasing. So your fees are earned as a percentage of the underlying assets you have. And if those assets are appreciating faster than the outflows are going out, you're making money. And there's a lot of tradfi companies that are just like sitting in the market and benefiting from, the upward equity moving market, which obviously as a Bitcoin podcast, we can talk about like M2 and money printing and all these things. So like there's just these cash flowing business where they're just sitting there despite money leaving, they're earning more money. So yeah, I think there's multiple things, but I do think a lot of what Mike is saying is good. It should be talked about. There are genuine concerns with passive getting too big in certain areas. I have plenty of examples I write about where passive is distorting underlying markets, but for the most part, those are like small ETFs that have weird rules and they get too big for the underlying stock. It's not like the S&P 500 types of things.
Mm.
I mean, we could talk about this for 3 hours. Honestly, this is something that I've been covering and I go really deep on in my research when I'm not doing anything on crypto or Bitcoin. So I know I talked a little bit much there, but I'll stop.
Yeah, no, that was really interesting. Maybe next time we'll have to do an hour long podcast just on that to talk about it. But I agree, it's fascinating.
I actually am. I don't know if it's debate. I am on stage with a moderator with Mike Green on October 20th at an event, and we're going to basically be debating this, going back and forth. Problem is, we kind of tend to agree a little bit more than we don't. Like we agree on like the most of the things, but like I just don't know what the solution is. Like, are you going to ban passive investing? Like that's just insane
Yeah,
to me. That's
yeah,
not going to
yeah,
happen.
yeah.
I mean, passive investing, what Vanguard did, has returned more money to end investors than anything else in the history of finance. John Bogle, who founded Vanguard, is should be a saint. The amount of money that he saved people, if you're paying 10 basis points to get exposure to the S&P 500 versus paying 1% over like a 10, 20, 30-year period, like you are literally saving everyday Americans hundreds of millions, billions of dollars at the end of the
Yeah, no, that's a great point. Okay, one more question, and we can close it out. And you may not have much of an opinion on this, given you don't necessarily study this super closely, but maybe you do and you thought about it a lot. But Strategy has obviously been releasing these credit products, as Saylor calls them, the preferred equity, STRC, STRK, STRD, so on and so forth. What are your high level thoughts on that, just in general?
I love, I mean, as somebody who likes looking at the markets and likes finance, I'm fascinated. Like it's just super interesting to watch this stuff happen. Like even let's say worst case scenario, this whole thing blows up. Bitcoin has some big issue, and like strategy ends up having tons of issues, and these instruments have tons of issues. Like no matter how you slice it, it's still fascinating to me. Like obviously none of this is investment advice, but like he's basically providing some. So he talks about this all the time. It's like voltage, stepped up exposure, stepped down exposure to the underlying Bitcoin. He's harvesting the volatility of his share price and the underlying Bitcoin, and like granted there are like potential risks here, obviously. Like if Bitcoin goes down to sub 50K, I think there are genuine concerns that you would have to worry about. There's no way he hasn't, like, he's definitely thought about this. He knows the risks. He's talked about like when things could get hairy and what would happen, but like he's basically with the convertible debt market, he like saturated that with people who would want exposure to strategies, stock, and thus Bitcoin. Now he's tapping into a much smaller market in finance, a much more interesting market, I would say, and preferred. Like most people don't. I guarantee you, vast majority of Bitcoin people on here like didn't really know what preferred stock probably was
Yeah.
until Saylor started doing this. So, and I just think the various levels of like creating almost like a money market type exposure, a more high yield type exposure, more investment grade backed exposure. I think it's all fascinating and seeing how they all trade. I'm not a bond trader. I don't trade fixed income, or I don't write research about fixed income from at that deep of a level. But for me, it's fascinating and awesome to watch. And yeah, it's fascinating. So the one thing I am concerned about is like a lot of these other copycats following suit. There are advantages that strategy has because of its size, because of its options market liquidity, because of a whole host of different issues that I don't know if anyone's ever going to be able to catch up. So I just worry that there's going to be a lot of these other companies, both here in the U.S. and elsewhere around the world, that are going to run into issues at some point, and potentially cough up the coins. I mean, I could make a pitch like if I were a hedge fund out there and I was scavenging for things, I would look for one of these things that are in trouble and like try to acquire a big position of it and force it to sell off Bitcoin. There are ways you can create like a cycle of like bad situations here, if you're forcing a stock to dump its Bitcoin and buy back shares or things along those lines. So I am concerned about that in the next downturn. But I mean, can it be really worse than what happened with like Three Arrows and Grayscale and Genesis and all those things, right? Which again, none of it was Grayscale's fault, but they were like that. GBTC was definitely at the center of all of it. And FTX, I can't believe I didn't even mention FTX. So like, yeah, I'm worried about it as a potential downside risk, and I'm paying attention to it. But it's at the end of the day, I mean, what do you think on it? I'm fascinated by it. Again, I don't invest in it, so
Yeah. I mean, I'm absolutely fascinated by it. I mean, I think, Saylor's called it building digital credit on digital capital. I mean, I think if his thesis is, Bitcoin can appreciate at 21% roughly for the next 21 years and, keep appreciating at the money supply rate or a little bit faster after that, then, paying 8% or 10% makes a lot of sense. And everyone kind of wins. Someone gets leveraged Bitcoin exposure. Someone gets a consistent, fixed income payment. It's pretty interesting.
yeah, I mean, all of this is predicated on Bitcoin actually continuing to go up and with the benefit of like money printing and all those things, which like I know most Bitcoiners and I tend to think that makes sense, but like that's not guaranteed, right? So that's like in my mind, that's the risk. If you're buying these things, you're expecting Bitcoin is going to appreciate in value or at least keep up with, long-term inflation and money and of the money supply. But yeah,
Yeah.
he's basically creating, or he said this, he's trying to create a rates curve of, Bitcoin type exposure. So it'll be fascinating how this goes. I mean, I'm sure he's cooking up tons of other stuff. I saw an interview with him where he was basically like, yeah, I was just talking to Chat GPT back and forth about like how to structure some of these things. I mean, specifically which is the one that's like the short term money is it STRC? Which one is that?
Yeah.
Yeah, I mean that's fascinating to see. Like, there's nothing else that has been used like that in the markets. So I don't know. It's fascinating from my point of view. That
Yeah.
said, like again, it's not something I'm touching personally.
Yeah. I agree that it's fascinating. And, he has his strategy.com website, and a lot of these companies have their own dashboards. But like Strategy, since they're issuing all these, different preferred equity instruments, you can plug in values for Bitcoin's volatility will be this, and Bitcoin's CAGR will be this. And like, even if you put Bitcoin's CAGR 0%, it's like you could argue that a lot of these things are still, maybe priced attractively, even in the fixed income products. Even obviously the strategy would do bad if Bitcoin does nothing for the next 10 years, but arguably the fixed income products could keep working fine even if Bitcoin went sideways.
I'd be most interested to see how. I mean, he's kind of talked about this, that he wants to eventually become like a pseudo Bitcoin bank. I forget what word he actually used. Like, if there are ways to safely and securely put the Bitcoin to work and earn positive yield, like return on assets on the underlying there, I think that would go a long way towards making potentially some of these people that are extremely skeptical less skeptical of what's going on. So I'm sure there's probably things that are talking about doing that on that side of things, but we're not there yet. And time will tell.
Yep. It's going to be fascinating to watch the next 5 years play out too. But James, this has been awesome. We'll have to do it again at some point soon. So thanks for this.
Yeah. Thanks, Joe. It was good to see you.
Good to see you.